Please welcome Stan Higgins, CoinDesk, Julio Faura, Santander, Marwan Forsley, Align Commerce, Heiss Hyman, Deloitte, Chris Larson, Ripple, and Elizabeth Rosiello, BitPesa.
Hey everybody, welcome to the first panel of the afternoon session. Today's topic is building a better payment rail. Joining us today is Julio Faura, Director of R&D and Innovation at Banco Santander. We've got the CEOs of two Bitcoin payment processors, Marwan Forsley of Align Commerce and Elizabeth Rosiello of BitPesa. We've also got Chris Larson, CEO of Ripple. And finally, we have Heiss Hyman, who's a principal at Deloitte. So, as we're looking at the question of building a better payment rail, I think you have to first look at what raises that question. You know, what are the problems there that would, lead to that question? So I want to start with you, Chris. So what are the problems with, payment rails today that would, lead us to raise this question in the first place?
Yeah, so I mean, the big problem you have in today's world is you have a series of siloed networks that don't interoperate with one another. So the workaround for that has been something called correspondent banking system that works, but it's antiquated. And that leads to a lack of access. So only some banks can get access to correspondent banks, leaves out tons of the underbanks, certainly leaves out all the things we're talking about with IoT, for example. It's expensive. There's quite a bit of fail rates that go on. I mean, we think maybe 4% of global payments are failing. That leads to very large reconciliation costs. And the big problem there is that those costs make, the most important new use case, which is sort of new corporation, think about the Amazons, think about the Facebooks, making lots of low value, high volume, high velocity payments. That's what they need. Correspondent banking actually does just the opposite. It's for large value batch payments. So the system we have today just isn't set up for the world that we live in, and that's why everybody's looking to this new technology to solve that.
Marwan, anything you want to add to that?
Yeah, I mean, in addition to cost, which the more intermediaries you have in a transaction, the more the cost and the more the time. But, our view is that the cross-border payment experience is fundamentally a lousy experience built on old-fashioned technology. In particular, when you're doing business-to-business transactions, when you look at Bankwire, the amount of the steps that you have to go through to send a payment to China, for example, for the payer, you got to collect a whole bunch of information on the receiver. You got to do a trip to the bank, pay a bunch of fees, figure out foreign exchange, figure out cutoff times. You have no idea what happens to your payment after you send the payment. Equally lousy is on the receiving end because all you get is a bunch of notes in your bank statement, and you can't figure out that money belongs to what invoice and how to reconcile it, what to make out of the fees. So the whole system is based on an experience that's outdated that I believe should be replaced by modern technology. A good chunk of what causes that payment experience is actually the structure of the market, which is the correspondent banking market structure.
All right, so having identified these problems, I guess the next question would be, where in the world, are these problems the most prevalent? Maybe where are the opportunities to, attack those problems? If different countries, regions in the world, where are the big problem areas as it relates to payment rails today? Heiss?
I think it's in a lot of markets, and they're different in each market. So I think if you look at some of the emerging markets, it's probably cross-border transactions, as we discussed. It's about the remittance business, and it's the cost of doing remittance at the moment, and the complexity of that at the retail level. In those same markets, it's also the problem that banks just moving money from one branch to another branch, if it's sitting in two different countries, there's really an opportunity in those. And then I think also, as Deloitte, we've been talking to a number of customers, just in-country regulators, payment regulators, that are saying, is this not an opportunity for us to implement technology at a lower cost base? And obviously that can lower the barrier to entry so that we can also get more players into the ecosystem. So I think it's a combination of, there's a wholesale opportunity for the banks in the emerging markets, and then if you look at the more mature markets, there's an opportunity for product innovation, for really disrupting the way we define financial services products and how we interact with those financial services products in terms of payments, and also how do we open that up to a broader ecosystem, not just the existing players in the market at the moment.
Okay, well, maybe to unpack that further, we can talk about emerging markets, developed markets, but, I guess if you could narrow it down to, countries in the world, like where are the real opportunities to solve problems if you had to, maybe throw out some ideas?
Yeah, so I've done a lot of work building on the African continent. So if you think about South Africa, Nigeria, Kenya, those to me are real examples where we've, as Deloitte, worked with large global banks where we've actually implemented some of this technology, and we saw the real proof and case, sort of where if you transfer in the value from the one country, from standing in South Africa and you transfer to Ghana, and you can literally in less than 2 minutes complete the entire transaction. And nothing's for free, but almost for free. And that really demonstrated to me the use case for that. And it opens the market. All of a sudden, it gives people access to financial services ecosystem, which before they did not have the opportunity to share and to partake in.
Elizabeth, you want to hop in on that?
Yeah, and I'd like to step back a little bit and just echo what the first two comments were, because added into the counterparty relationships with some banks, you have an additional aspect for emerging markets. And I'm focused on sub-Saharan Africa, and we have no hard currencies. So how do you then add on the problem or the pain point of soft currencies or exotic currencies on top of delayed, dysfunctional counterparty banking relationships? So you have the counterparty banking relationships with exotic currencies. So who's going to make that market? When you make a transfer from the US to Senegal, they say, well, you'll find out what the rate is when it arrives in 14 days. Why is that? Well, who's making a ZOF market out of New York? And when you talk to the TransferWise of the world or Currency Cloud, they say, oh yeah, we operate in sub-Saharan Africa, but we buy our African currencies in London. Or you hear Barclays Africa say, well, we consider the Kenyan shilling an exotic currency. So that's the other thing nobody's really talking about. Well, why is it difficult? Well, added on to the delays is the fact that nobody's thinking about these currencies. So, and then the other thing I would say added on to, it's not just remittance. It's not a retail play. Let's go back to Facebook. Facebook wants to operate across the African continent. Now they work with Aiden, or a company that works with Earthport. Do they have a physical presence in these markets? Who are their counterparties? Are there PSPs that service them? There isn't anybody, maybe in South Africa, potentially just now entering Nigeria, but what about the rest of the continent, which is the growth story of the decade? This is one of the fastest growing middle classes in the world, and who's serving those needs? So how can these large companies enter the space? Nobody's investing more in sub-Saharan Africa than Google. You have Google electrifying and bringing online entire Ugandan city-states. You have Google Energy buying up all of northern Kenya. So who's then collecting revenues for them? So in addition to the counterparty problem, you have the currencies, and you have the fact that there's no one single entry point. So the infrastructure really needs to be built there, and someone really needs to focus on making a market.
Julio, you want to hop in on that?
Yeah, I agree with everything that has been said. In general, in retail payments, it's about cost, it's about speed. And it's also about transparency. It's even difficult for banks to, you just go to a branch or you go to the internet and you try to make a transfer, and it's embarrassing, but it's difficult to tell them how much money is going to be and how much time is going to be. But besides retail payments, it's actually in corporate payments as well that happens. And it's not just that we want to make a better service. It's actually that there is a lot of savings to be realized for everyone. I'm not talking just about cost. I'm talking about capital as well. So if you send money and it takes 2 days to arrive to the other side, those 2 days means that the money is in flight, and therefore that needs a credit line, and therefore that means capital consumption. And actually, under the rules of Basel III, the capital consumption coefficients are going to be way higher. So it's definitely in the interest of everyone, not just the financial, not only the users, but also the financial industry, to make better rails where money can move faster, because all the cost, but also capital savings could be realized.
All right. So now that we've taken a look at some of the issues involved in payment rails today, and where some of those issues are most felt, let's look at the opportunities to both solve problems, build new businesses, generate profits. So I want to start with you, Marwan. So what are So where are the opportunities there? How can we, help people build new businesses, spur economic activity? Take it away.
Yeah, so I think, so just a couple of context points. We are running in 60 countries. We operate on two main principles. One, that the experience to the user got to be really simple. When you send payments overseas, it should be as simple as paying for a domestic payment. It shouldn't be like a long procedure to do it. The other operating principle is that we operate with multiple rails, and we want to make sure that the rails are hidden from the user and they're contributing to the experience itself. So we've functioned mainly on the blockchain, but we also added a number of traditional rails from our own bank accounts to local payment processors, and we also experimented with other cryptos besides the Bitcoin blockchain. So we're constantly comparing and contrasting between rails. The key thing is to have the rail and the technology help the business user or the customer. And so you want to make sure that the technology is bringing savings and it's concrete and it's measurable. That's both in money and time. And it's providing fundamentally a better experience to the user than what you have today. When I look at the architecture of the blockchain, fundamentally, it's a different architecture than what you get from traditional payment systems. And because there's no intermediaries, there's no middleman, you have the ability to save time, you have the ability to save money, and you can provide a simpler customer experience to the user. And that's concrete. You can measure it. It's not something that's theoretical. You can compare. You can do an A/B split today between a bank wire and running it on other rails and see the difference between the two. And you can measure that.
Chris, any thoughts on that?
Yeah, I mean, I think the big opportunity is twofold. One is going to be on digital assets and how they're going to help sort of the world reach the liquidity in a more efficient way, I think, to the points that Elizabeth was talking about, particularly in the exotic corridors. I think that's where digital assets like Bitcoin and Ethereum and XRP could be very helpful in lowering those costs of liquidity. The other area we think is in interoperability, and there we think blockchains probably don't play much of a role, because at the end of the day, a blockchain is just another network, and the whole point here is how do you create interoperability between all networks. So our bet there is it's going to be something more like the Interledger protocol, which is not a ledger, but it's just a way of allowing two ledgers to exchange value atomically without anybody in the middle in real time, and almost to be like that IP for our value network. So those are the two completely different use cases. I think everything we're talking about here today, but they're crucially important in setting up this internet of value that is upon us now.
Keith, any thoughts on that?
I think there's opportunity obviously for cross-border, low-value, high-volume payments, but I also see opportunity for in-country payments and just doing person-to-person payments and same currency payments and disrupting that area. And then definitely the other area that I think is an opportunity is around the merchant transaction acquisition, and saying how can we acquire a transaction? And the question is, do those have to be separate payment rails? I understand that you need performance on the merchant transaction acquisition, but that creates the opportunity to say maybe we can have a single payment rail. I think the worst thing that we can end up with is that we have, again, a proliferation of all these different, payment rails out there. Then we just, add it to the monster that we're already struggling with, and it will not drive down the total cost of ownership. We've actually just then increased it. So to Chris's point, I think interoperability and coexistence of these payment systems are key in those opportunities that we create.
So what do you think would be if you had to give a top 2 or 3 priorities in this regard, the major opportunities there that maybe a prospective investor or, a startup, founder or even a developer, what should they be looking at most, in terms of weighing the opportunities that are presented by this question of building a better payment rail?
Yeah, I mean, the demand that we're seeing, certainly in terms of the conversations we're having with the organizations out there, is wholesale payments and business-to-business payments is a key area of friction at the moment, and looking for solutions. The next to that is retail payments, but that's lesser priority. We always sort of gravitate to corporates, wholesale payments. I think more time needs to be spent into understanding the business model. So what is the actual revenue model going to look like by the time that we're done? So if we've disintermediated the middleman, what is the role of the bank in the new operating model? And what does the service delivery model look like? How do we actually service the customers? And we're spending a lot of time. So on wholesale payments, I definitely think And it's also one of the use cases that we've built out to demonstrate that in our lab. Next one, I think, is retail for the emerging markets. I think both in-country and person-to-person, not just cross-border. And then I think, for me, a really great opportunity would be to start looking at the merchant acquisition. And probably because of my background, but I believe there's a huge market around informal merchant and merchant transaction acquisition outside of the current card payment networks.
Marwan, any final thoughts on that?
I agree. I think there's also a problem in the market with micropayments. Low-value payments is really difficult for cross-border. And I think there's an opportunity there for better rails to service that market.
All right, cool. So, the reason we're here today is to discuss, building a better payment rail. But I think there's another key reason that, we're on this stage, that we're all in this room together today is because of Bitcoin. And I don't think that you can have a conversation about building a better payment rail without bringing Bitcoin into this conversation. So what I want to put to you, Elizabeth, is, why does Bitcoin matter in this conversation? And, when we're talking about, maybe these bigger financial firms looking at this question, you have startups looking at this question, why should Bitcoin matter to them?
Yeah, I love this question. And anybody that's heard my pitch, which is probably everybody in this room, knows that I go on about this with the story. Why am I using Bitcoin? Why do I need Bitcoin? So, I used to work at a prime services desk of Credit Suisse. Some of my clients were the largest hedge funds in the world, getting all sorts of great transactional services. Then I moved to Nairobi, Kenya. Now, I clearly am no longer able to get a prime brokerage account with Credit Suisse with my startup in Kenya. So how do I come to the table? Where do I get liquidity? Who will open a trading window for me? How do I interact with a broker in Guangzhou or in Toronto? Well, that's where Bitcoin first came in, and that's where Ripple and other companies can come in. Suddenly I put a flag up and I say, well, I'll accept this other kind of value token, this other synthetic currency, and suddenly people raise their hands. Now there's new people at the table. It's not the same old boys. Sorry, gentlemen. So for me, it gets me to the table. It lets me start my product. It lets me see, well, actually P2P remittances isn't going to work. Let me move on to B2B. It lets me find my clients. It lets me do it all at a very low burn rate. It lets me start to grow. Now I've moved to 6 countries. Now I'm seeing significant volume. I'm working with the largest payment providers and banks across the region. And I was all able to do that in 2.5 years. So without raising my hand with this new, what I would call democratic, technology, I wouldn't have been able to do that. I would have had first to raise millions and asked Oracle or IBM or Deloitte to help me build some gigantic system that may or may not work with my partner across the street. So for me, it got me to the playing field, and it will always be a part of the technology that I offer. But it's not an end-all, be-all. It's a strategy. And I think that's where a lot of companies go wrong and a lot of startups go wrong. They say first, we just want to think about one technology, and they don't want to think about what the business product is or what the customer market fit is. I think interoperability right now, that's the biggest question. You have to be able to use what your customers want to use. If I get in a gigantic account and they don't want to use Bitcoin, am I going to turn down that account? No. At first I'm a businesswoman. So what do I need to use for that? Now, I will always offer Bitcoin. That flag will be always up unless it turns into something else. So I think we need to always think about what do the customers want, what's working for them, and what's the evolving technology. But I'd have to say without the Bitcoin community and without this technology, I would not be able to pay my global employees. I would not be able to make a transaction with a counterparty that I just met with full faith and go to sleep at night, and I would not be able to kind of process things with such a low operating expense.
Julio, any thoughts on that?
Well, I guess the whole Bitcoin world is seen a little bit differently from the ISO Bank. Mm-hmm. And I think by itself it's a great self-contained experiment. And it's kind of the inspiration for all this, right? It's where it all started, and I think it's relevant because of that. Now, when you try to make all these things real, I'm sorry to use the word real, when you try to work with existing rails and existing gateways, you try to really make it in everybody's life, it really work. Then, in my opinion, Bitcoin gets a little bit small. In the sense that if you know a liquidity token to really exchange value between things, it's probably better if you go for a more fit-for-purpose kind of token, like, for example, Ripple is doing with XRPs. Because otherwise you're going to have a lot of people with different backgrounds, different uses, and different levels of legality coexistent in the same space. So I think in general, it's where we are favoring real implementations, where we go for particular implementations which are fit for particular purposes, and then try to see how these things could interoperate using interledger protocols or using any kind of ways to transfer value from one to another. The other important lesson I think we should not lose is the governance lessons from the Bitcoin world as well. Whatever we build in the future, I think it's important to make sure that we can control it and make it evolve, so we don't run into some problems that we've seen lately.
Elizabeth, any response, final thoughts on that?
I was having trouble hearing him, actually.
Marwan, you want to jump in on that?
Just one thing about Bitcoin versus other protocols. I mean, at the end of the day, the issue for me is that a lot of the protocols, to be able to do transactions, you need liquidity in the market. And that's been the biggest issue with alternatives to traditional methods. The reality is the Bitcoin blockchain is liquid. I mean, liquid enough that you can do transactions on. But I believe that that's the biggest problem in the market is really liquidity issues. And so the more the network is liquid, the more you can run in at scale. It's kind of like when you have an electric car, you need plugs. Otherwise, the electric car has no utility. So like, to me, liquidity is the key prime factor for making all of this successful.
Keith, any final thoughts on this question?
I think for me, obviously, it's around the liquidity as a key factor. But for me, also, Bitcoin actually demonstrated in terms of creating a payment rail, the art of the possible. It's an open chain. Everybody shares in it. It's really low at the barrier to entry for new participants into that ecosystem. And I think the lesson that we should learn from that is that if all we end up is creating a bunch of private chains again, that we have to then create interoperability between all those private chains, then I'm not sure how successful we were. Part of the benefit in the Bitcoin network is that it is open and it is really low in terms of getting entry into that ecosystem, whether you're the man in the street or whether you're, ideally if you're a corporate and you want to partake in that payment protocol.
It's open source. You can build all kinds of apps.
You can pay, yeah.
Cool. So one thing I also wanted to cover today, and I think this is, a very important topic when we're looking at this question, is the nature of legislation that targets money laundering and terrorist financing. And I think everybody on this stage, running the companies you do, this is a subject that I'm sure comes up more often than you'd like. And so what I want to talk about, first of all, are, as a company operating in the financial space, when you have, governments and, and political pressure and a move toward, higher compliance costs and, more regulation in this area, what are the major challenges facing, both incumbent financials, but then also startups as well? And so I want to start with you, Chris.
Sure. I think a lot of this Internet of Value sort of started trying to replicate what happened with the Internet of Information, which was dominated by technology. And I think, the first innings were dominated by technology. And I think what we've all found is that there are some similarities to how Internet of Value is going to grow up, and there's some fundamental differences. Value is just a different animal than information in that it's not just tech, it's tech integrated with risk, integrated with compliance, all at the same time. That's actually why we think banks are really well positioned as the sort of foundation of the Internet of Value, because they're really good at reconciling those three different domains. But I think things have calmed down. I think the industry, has brought in the dialogue with regulators. I think things are in a pretty settled state right now. And fundamentally, if you look at the way all these systems work, they're way more transparent and much more visibility from a cross-border perspective. Talk to any AML expert who traced, bad guys through correspondent banking. It could take them months to go from ledger to ledger to ledger. You have the opportunity now with distributed ledger tech to see that in real time. And I think most cybercrime experts would say real time is the way to catch the bad guys. So this is a good thing.
Elizabeth, any thoughts on these challenges? What it means, for your startup as a company, your employees, the business you guys do. What are your?
Yeah. So I'm at the bleeding edge. I mean, I've lived for 9 years behind an electrified fence. I've been living in countries that are at war with Somalia. We are high terrorist alert all the time. So the government is obsessed with AML KYC, and why I might not philosophically agree with that and share some of the thoughts of many in the Bitcoin community, that's just my reality. So there's no way you can launch a business without using the most stringent, even higher than any bank in the region, controls. And we've, from day one, set out to use global best practice, even if the banks in our markets aren't doing that. So, you have banks up north and you have banks in my region which have gigantic Swiss cheese holes in them, and they're being shut down all the time and there's constantly problems and they're losing their correspondent bank relationships. So for us, it's really to set the bar. And I used to work in microfinance with a lot of the regulators as they developed that regulation. And at the time, you had like thousands of banks in Nigeria that were unregulated. And finally, the regulation was passed and it came down to 200 banks. So for me, I've seen this cycle happen already. So the regulation isn't there, but when it comes, you have to be the first one online that's the most compliant. So how do you work with regulators to help them develop the regulation that fits best? And, we show a matrix usually which says, are we a commodity? Are we a payment processor? Are we an MSP? I know Marwan, operating in the US, is a very different compliance matrix than what we would see in other regions. Often they say that we are actually a payment processor or potentially even a commodity dealer. So market by market, how does it look like? And how do you, as a group, as a regional, we call ourselves a Pan-African platform, how do we then hold the utmost compliance standards across all the different market expectations? And for that, I think AML KYC is a very simple question. You just have to know who you're dealing with and whatever that takes. So although there's country by country regulation, you have to make sure you have a team onboarding your customers, looking at transactions, looking for suspicious activity. You have to ingrain that from day one or else the costs will overwhelm you. If you don't build that into your process and your business model, then at a later date when it comes down on you, it will crush your business.
So, Julio, we've heard from, Chris and Elizabeth on this, so I kind of want to pull you in on this, to get, the banking side of things. So, so where are these challenges and, how do they impact, the process when, you guys are looking at this question of better payment rails?
Well, I think for banks it's not that much of a choice to do email and KYC and all these things. I once said in a panel that that's a part of regulation that is actually useful. And you see, these things are really not much of a choice, and we really need to comply with this thing. I think the banking industry has spent a lot of money and a lot of effort to actually try to stop the bad people. And it is something that shouldn't be really stopped. What I can say from the dialogue we're having with regulators and central banks and governments and so on is that everybody's really very interested. And it's very positive about the whole thing. As Chris was saying, I think this really adds trackability, right? Traceability. You can, it's way easier to audit these things, to supervise these things. It should lead to actually savings in terms of compliance and audits and so on. We need to solve some questions though, like privacy, for example. The more open and the more auditable it is, then the less private it is as well. And at some point, regulation will need to choose between more privacy or more transparency, really. And the other interesting thing is, as soon as we move into more digital money that can be tracked more, then it will lead to other benefits for governments as well. Like, for example, the difficulty to evade taxes, which is a major problem in cash-based economies. And you guys know that I come from Spain, so it's not only emerging markets. Let's call them. And finally, just probably a more advanced comment would be around this concept of trust. Because when we use distributed ledger technologies, and actually the benefit, the promise of Bitcoin was really to remove trust of the question, so you would not have to trust agents in the middle and so on. Well, the thing with that is that if you remove the need for trust, then you remove the ability to have people you can go to when you have problems. And that is something that I'm not so sure that the world is ready for. Like the impossibility to revert transactions and the impossibility to fix things when they go wrong. And I'm not talking about cryptography. I'm talking about you, for example, making a mistake or things like that. So if everything is over automated, let's say, so everything just depends on cryptography and not on institutions or trusted institutions, then it's a whole new world for regulators, because they will not be able to actually chase people when there's an ability. I mean, there's the need to revert something or fix something manually. So it's going to be interesting.
All right, well, to kind of springboard, from there, I want to turn to you, Marwan. So what are the opportunities for this technology, whether it's Bitcoin in particular or another blockchain application? What are the opportunities for this technology to actually address and maybe solve some of these issues?
So I think it depends on the use case. So for example, if you're using Bitcoin or crypto in general for transmission between regulated payment types, then the transaction is going from a bank to a bank where KYC is happening on both ends, and you're going between regulated payment systems. That's a very different use case than Bitcoin native, where you're transferring money between businesses or consumers. So it's harder to track if it's only Bitcoin, but it's a lot easier to track if it's going fiat to fiat, where Bitcoin is transmission. The key thing is all these things, payment systems, for them to scale, they need to follow regulation and compliance. That's essential for scaling. Otherwise, the whole idea will become a side idea. But it's also extremely complex, because you're dealing with cross-border situations where you have two compliance and regulatory regimes, and for every transaction you have two different regulatory regimes that you have to follow. I think the opportunity is for the regulators to think about new technology and the attributes of the new technology, and not take existing text and move it over to the new technology, because you don't benefit from what you get from the new technology. Because there's significant tracking and transparency you can do over any crypto. A good chunk of compliance text is to try to provide more tracking and transparency. When you actually have that built in native to the protocol, why make the text more complex? Why not simplify compliance and regulatory, the framework? So there's a tendency to take what we know and port it over to the new technology, which I think is complicating things. I hope there's an opportunity to simplify it and embed all kinds of KYC into the protocol and all kinds of tracking and transparency.
Keith, any thoughts on this?
I think regulation, in my mind, is key to building trust and reputation, and that'll drive to a sort of critical mass and adoption. I think what we've got to be careful for is that we don't regulate it in the same way the existing environment is regulated, so that we don't enforce that same regulation just onto how we do blockchain, because I think then we're going to potentially lose some of the benefits and the innovation around that. And that was said this morning as well. And what I liked about it is, let's learn out of the process, and as we're learning out of the process, and I think as we're getting critical mass, to Chris's point, regulation will come. I think one of the risks that we run is that every country comes up with their own set of regulation for these new payment systems, and that eventually that regulation starts contradicting each other. So I think it's important not only to have standards on the payment system, but also to have conversation and dialogue between the regulators to make sure that we come up with a common sort of set of regulations as far as possible.
Chris, any final thoughts on this?
Yeah, I mean, I think there's actually a lot of good work that's going on right now. World Economic Forum is trying to really get the regulators, the incumbents, and the entrepreneurs working together globally. There is an effort underway, I think, to synchronizing some of the global regulation. And that probably wouldn't happen without sort of the whole blockchain movement, because finance has always been very siloed country by country. This is the first time you ever had a fintech sort of movement that's global from day one. So there is a lot of good developments underway here.
Cool. So we are unfortunately running a little low on time, but one thing I do want to get to before we finish up is, I think that there are, many developers and, prospective startup founders out there who are looking at this question of a better payment rail. And what I want to put to you guys before we finish is, I'd like an answer, from each of you guys is, what's the number one thing from your perspective that, future developers, startup founders, company owners, what's the one thing that they should bear in mind the most when looking at this question? I want to start with you, Elizabeth.
I think what's interesting about payment providers, and I've worked with a lot of them, and I mean, often it comes down to cost. Can you really build a cheaper model? And it's clunky now. I mean, there's a lot of growth to still be done in the sector. And we have worked with a lot of partners who, in the end, the price point's not there. And when you have to work with 2 partners, or unless you have total global reach, I mean, you guys are lucky. A lot of us work together or cobble together global solutions. So how does it work on the cost side? So I think a lot of companies are still figuring out what their profit model looks like. And we've certainly worked with a lot of companies, smaller companies, that haven't gotten that price point right. Because if you're going to come into a big client and you have a drastically different technology and your regulation is still under processing, then you better be really cheap or you better be really smooth. So, I mean, you can't just come in and say, well, we're better fundamentally, because you have to really have that performance there. Because although there's a lot of delays and a lot of high costs, I mean, it's just very familiar. The old ugly way is very familiar to a lot of companies. So I think you still have to have a much more superior product and really focus on that.
Julio, any thoughts on this one?
Well, I think this is a year where we want all these things to be real, right? After a couple of years thinking about technology and speculating about potential use cases. So I think, at least from the financial world and from much of the startup world, I think, and without trying to put all the stuff in the new rails, as you were saying before, I think it is wiser, or probably more likely to happen, if we go a little bit of an incremental approach, like trying to substitute parts of the system, right, without trying to reinvent it all over, just the whole thing, because otherwise it's going to be difficult. It's a very complex system, and it's a lot of moving pieces, and there are particular parts which are very ripe for that. So we will be working to try to, first of all, represent fiat assets like money and capital markets instruments on ledgers. And then we'd love the whole community to innovate using those cryptographic representations of assets out there, right? I think it would be wise for them to focus on those things that actually help transform the rails on which we are working, rather than to reinvent the whole thing.
Marwan?
I'd say what would be really interesting is to use technology to provide a totally different experience to what you have today. Think of like Uber versus taxi, or Netflix versus watching DVD at home. I mean, they're totally different experiences. So how can you use new technology to bring something totally new to the user? Something that's fundamentally different, as opposed to minor incremental changes.
All right, cool. All right, we have 20 seconds left. Geese, 10 seconds. What's the number one thing that those parties should keep in mind when looking at this question?
Think of the entire business model, not just the technology. So where you're going to make money, and what is that differentiated customer experience going to be?
Chris?
Yeah, I'd say think about solutions, not technology. Don't sell a technology, sell solutions. Yeah.
All right, well, guys, that finishes our panel today. I want to thank you very much for joining us today. And thank you very much.
Before you go on,